Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, it's been 2 weeks since the last show and the markets are still wrestling with the future direction of both inflation and economic growth. Now, in recent weeks, markets have also struggled for direction in the absence of any lead from global central banks, in particular the US Federal Reserve. Now, a combination of rising Delta variant cases and disappointing economic data, not just in the US, but also in China, alongside tensions in Afghanistan, sent the 10-year US Treasury yield tumbling to 1.228%. And investors began positioning themselves for the reality of stagflation in the US and other Western economies. Now, last week I published an article for 80/20 investor members highlighting how to take advantage of a stagflationary environment in the US and Europe and the investment funds that could benefit from such a scenario. But to give you some insight, technology stocks and defensive sectors such as healthcare, consumer staples, real estate, they would all likely do well during a period of stagflation and would be probably among the biggest beneficiaries. Now, if you want to see a copy of that research, then you can do if you take out a free trial of 80/20 Investor. Now, since the last show, the meeting minutes from the last US Federal Reserve's policy meeting were actually released. Now, the minutes suggested that the Fed could decide to reduce its quantitative easing, so QE program later this year. That's the bond buying program. Now, back in 2013, we saw the market react negatively to talk of QE tapering back then, and the bond market's reaction became infamous with yields surging, and the stock markets fell around 5% at the time. Now, the Fed will no doubt want to try and avoid such a situation in 2021. Although most stock markets around the world did fall around about 2% after the meeting minutes were released. That's the days after, and actually the days after the last video was made, the last show. Now, we did see a pickup in equity market volatility following those meeting minutes, and there were concerns that this could escalate into something a bit more troublesome, where pretty much everything sinks at once. That's most equity sectors and even bond markets to a certain extent. It meant that all eyes were on the Jackson Hole Symposium. Now, that was the get-together for central bankers, economists, and policymakers from around the world. And if you recall, it was occurring last weekend. Now, any hope of unguarded and off-script comments from central bankers that could give you an insight into future money policy were dashed when the event was actually held online rather than being in person. And that was actually due to concern over the Delta variant itself. So something slightly ironic, given that that is one thing that policymakers are obsessed with when it comes to future economic growth. Now, nonetheless, there were headlines that were produced from the event, and depending on which you read, there were suggestions that the US Federal Reserve was more dovish or hawkish than previously thought. But if we look at the market's reaction since that meeting, that get-together, then the market has interpreted more dovish than anything else. And the investors believe that the Fed's monetary policy support is here to stay for a while longer, particularly in the face of uncertain economic growth. Now, if you look at the sector performances on the S&P 500 in America over the last week, then the reflation trade beneficiaries, if you remember those, they were the financial stocks and energy stocks. They've fallen, while sectors that I've mentioned earlier that are likely to be beneficiaries from a stagflationary environment have popped higher. Now, real estate stocks, for example, are up 3.5% since the 30th of August, while energy stocks are down around 3.75%. In the meantime, technology stocks have also rallied. As I've mentioned, they have often been a beneficiary of a stagflationary environment. So if you look at the S&P 500 and the tech-heavy NASDAQ, they have gone on to set new all-time highs in the last few days, driven by those technology stocks. And it reinforces why the last episode of this podcast was titled Equity Markets All-Time Highs Should Be Welcomed and Not Feared. And now, in the days afterwards, US stock markets did fall. So some people may have thought it odd at the time that I gave it that title, perhaps a bit bold. but the evidence does suggest that you should welcome all-time highs. They are a bullish indicator. Now, the exception to these all-time highs in the last week or so has been the Dow Jones in the US. Now, that is understandable given the cyclical exposure of that particular index. So that was one of the beneficiaries of the reflation trade, if you remember. Now, jumping over to the UK, the FTSE 250 clocked up yet another all-time high yesterday, while Asian equities, and most notably Japan and Chinese equities, are still yet to break out of their downtrends that have been in place since about February time. But we are seeing tentative signs of life in those markets as investors are betting on new stimulus hopes from the Chinese policymakers off the back of more poor economic data in China. So that positive sentiment bled over into Western stock markets, which obviously boosted them even further this week. So there are more positive signs out there in equity markets. And then, of course, we are heading into that year end where we do get a bit of a seasonality push ahead of the Christmas period. But don't forget, if we go back a couple of years, that we did have a pullback in the autumn. So markets are still looking very stretched at the moment, but we'll have to see what happens in the coming days and weeks ahead. But one chart that investors are obsessed with and still are is the 10-year US Treasury yield. It does remain in its current downtrend at the moment. It's at about 1.29% as I make this show. Now, we have seen a run of higher lows in the last week or so, which means that downtrend that we've seen of falling yields on the 10-year US Treasury is now being tested on the upside. Now, much will depend on where yields go. It will have a big impact on not only bond markets, but also the stock market more generally in the US. So on that sort of sector rotations, we could see if we break higher, particularly above 1.3%, close above there and continue to push higher, which seems to be the consensus prediction. Now, if we see a break above that 1.3% level and it closes above there and continues to push higher, which is the consensus prediction, then we could see more rotations in equity markets. So that means things like the reflation trades, financials, for example, could get a boost. Just as we've seen these rotations back and forth a number of times already this year. So don't be surprised if we see that in the coming days and weeks ahead. So there's a lot to look out for at the moment. Keep an eye on the 10-year US Treasury yield as ever. Lots going to depend on what happens with the Delta variant in the coming weeks and months. But of course, whatever happens with central banks, particularly the US Federal Reserve, is going to have a massive impact on markets. And we have got more policy meetings, Bank of England, US Federal Reserve later on this month. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with the number 2. Of course, you can contact us on Facebook, Instagram, TikTok, and of course, don't forget to subscribe to our YouTube channel.